This is not financial advice. I'm recording my thoughts about C Limited. In this video, I'll give a brief update about Q2 2022 results, the real reason why the stock is down, and the stock evaluation in 2026, and the two scenarios in which I will buy this stock. C Limited stock is down about 14% after they announced their Q2 2022 results. The revenue as well as the earnings per share are not huge misses. They made about $2.9 billion of revenue, and that represents about 29% year-on-year growth, and they lost about $1 billion. $1 billion of net loss sounds like a lot, but they have about $11 billion of cash left. So I don't think they'll go bankrupt anytime soon, or there is a need to raise any money soon. So I'm hoping that there will not be any stock dilution. In my opinion, the management is really smart. They raised $11 billion of cash when the stock went up to like $300 by uninformed investors like us who just bought this stock thinking that this is the next Amazon of Southeast Asia. Now let's look at the reason why the stock is down 14% when there is no huge miss of revenue as well as earnings per share estimate, right? So for this, we need to understand C Limited's business model. They have three different revenue streams. The first one is Garena, which is their digital entertainment or gaming division. Number two is Shopee, which is their e-commerce division. And number three is C-Money, which is their payments processing platform. Garena is very profitable business. This is their gaming division, and they have a game called Free Fire, which is extremely popular. In this digital entertainment sector, their gross margins are in the order of 80%, which is extremely high. And so they can make about 35% net profit margin in this segment. So Garena is the most important segment for C Limited. And Shopee and C-Money, they're growing fast, but they're losing money significantly, and their gross margins are in the order of 20%. So if there is a 20% gross margin, the net profit margin will be negative, right? So they will not make money in those two sectors long time in the coming future. So the real reason why the stock is down 14% is because of their most profitable sector, Garena. The revenue is decelerating. They lost about 12% year on year this quarter. And in the next quarter, they're saying that the bookings are only about 707 million. So 900 million to 700 million, that's about another 20 to 25% deceleration. If your most profitable sector is decelerating in revenue growth, that is a big concern. That is why the stock fell. So let me give you a quick snapshot of the earnings. Let's focus on the green line in the screenshot that I'm showing, which is digital entertainment, which is their Garena. If you look into the revenue, that's about $900 million. And the green line is going towards the cost of revenue. That's about 260,000, right? So the cost of revenue is only about 30%, right? So the gross margins are in the order of 70 to 75%. So that is great. Now let's look at the other two sectors, which are e-commerce, which is shown in the red line, and the sales of goods, which is in the blue line. If you look into the red line, they made about $1.7 billion. And the cost of revenue is about $1.3 billion. They're only making $400 million gross profit. So that's about 20% gross margins, right? So that is terrible. They need to really work on their execution and get these gross margins to about 40 to 50%. So at least they can make 10 to 15% net profit margins. Get the idea here. Their digital entertainment is the most profitable sector with more than 70% gross margins. But they have a lot of work to do in the e-commerce and other services in which their gross margins are only in the order of 20%, and they're losing money left and right. The stock is currently trading at about $77, and I need to make an investment decision to buy this stock or not, right? So for that, I need to look into its evaluation in 2026. So this is a very rough estimate, but at least it gives me an idea of where the stock is headed so I can take a decision. If you have watched my Amazon's evaluation video, you would know what I'm going to do. I'm going to separate the evaluation between Garena and e-commerce and other services. Garena is high profit margin and high growth business, and the e-commerce and other services are also high growing, but they have very low profit margins. So they get different multiples. So I'm going to do the evaluation separately and add the stock price up at the end to give a stock price prediction for C-Money. Now let's look at Garena's evaluation. In this year, they are expected to make about $3.6 billion of revenue, but we already know that the revenue growth is decelerating. From past year to this year, it decelerated by about 12%, and in the next quarter, we already know the bookings are down by about 20%, right? So this is a decelerating business. So I'm only going to assume a growth rate of about 5%, which would give me $4.38 billion of revenue in 2026. Since this is a high gross margin business, I'm going to assume a 35% optimistic net profit margin. They will make about $1.5 billion of net income. For a company that is growing in the 5% range and has a net profit margin of 35%, I'm going to assign a 22.5 multiple, which will result in a market cap of $34 billion for Garena. And currently they have about 561 million shares, and like I said before, they have $11 billion of cash, so I'm not going to assume that they're going to do any further dilution. So I'm keeping the share count same. So that will result in a $61 stock price for Garena itself. Now let's look at Shopee and C-Money. In 2022, they are expected to make about $8 billion of revenue, and they grew their business by about 75% this quarter. But as the company grows bigger and bigger, it's hard to grow faster, right? So I'm going to assume a 50% growth rate, and that will result in a $40 billion of revenue in 2026, from 8 billion to 40 billion in 5 years, right? It seems optimistic. So, however, with respect to net profit margins, when their gross margins are 20%, the net profit margins would be negative. But in the next 5 years, I'm counting on the management to do better execution and increase that gross margins, so I can have at least single-digit net profit margin, right? We do know that Amazon's e-commerce business has single-digit net profit margins, right? So I'm assuming that Shopee will get as efficient as Amazon and get to that single-digit net profit margin. So I'm assuming 5% net profit margin, which will result in $2 billion of net income. And I can assign a multiple of 20 here because the net profit margin is so low, but the growth is about 50%. So with a multiple of 20, the e-commerce and other services business would be worth about $40 billion, and that will result in a stock price of about 72. So Garena is $61, and the rest of the e-commerce and other services are worth $72. So when I combine them together, it's about $134, right? But this $134 is an optimistic estimate, right? Because I'm assuming that Garena would still grow about 5% year on year, but in reality, it's actually decelerating, right? So that is a huge ask to have Garena grow about 5%. So that is why I'm saying it is optimistic. And on the e-commerce and other services side, I'm assuming a net profit margin of 5%. Growth is okay, but net profit margin is what I'm worried about because it depends on their execution. Overall, I have about $134 projection, right? Currently, it's about $77, so I'm not even having a 2x in 5 years. So I'm not going to invest in this company, but I will think about investing in one of the following two scenarios. In the first scenario, whenever I see high risk, I want high reward. If it falls below $30, I'm looking at a 5x, so I will have a cushion, right? A factor of safety, so I can take a decision to buy this stock. On the other hand, the second scenario when I would buy this stock is when I have evidence that Garena can grow faster than 5% year on year. And on the Shopee and C-Money aspect, if they increase the gross margins to about 40 to 45%, I will have a belief that they can make money there, right? So if they do that, then also I'm going to buy this stock. So these are my thoughts about C Limited. It is a complicated stock. It is hard to evaluate. If you have watched this video once and did not understand much, you have to watch this again to get a better idea.